You ever notice how your money disappears faster when you're emotional, not when you're broke? Here's the uncomfortable truth most people never admit. You don't spend money because you need something. You spend because something inside you wants relief. Stress after a long day, pressure from social media, the need to feel enough for a moment. And in that moment, logic quietly leaves the room. Think about it. A bad day at work turns into online shopping. A feeling of emptiness turns into ordering food you don't even enjoy that much. A friend's success story turns into buying something just to feel like you're not behind. It's never just about the item. It's about the emotion you're trying to fix with it. There was a young man who saved for months to build a small emergency fund. He promised himself he wouldn't touch it unless it was urgent. Then one stressful week hit. Arguments at home, pressure at work, exhaustion building up. One evening, while scrolling his phone, he saw a watch he always wanted. In 10 minutes, his savings were gone. Not because of need, because of escape. This is emotional spending. And it's one of the biggest silent killers of wealth. Because here's the twist. Every emotional purchase feels small in the moment, but they compound in the opposite direction of wealth. Instead of growing your future, you're constantly paying for your present feelings. If this is hitting you right now, pause for a second and reflect. How many of your purchases in the last 30 days were actually planned, and how many were emotional reactions? And if you're getting value from this, subscribe because we break down the real psychology behind money most people never learn. And comment below, what's the most emotional purchase you've ever made? Now here's the shift you need to understand. The goal is not to stop spending. The goal is to stop letting emotions decide for you. Because once you regain control here, everything else in your financial life starts to change. Fear of risk doesn't look like fear. It looks like being responsible. It looks like waiting for the perfect time. It looks like saying, I'll invest when I learn more, or I'll start when things are stable. But underneath all of that is something much simpler and much more powerful. The brain's deep resistance to uncertainty. Because risk doesn't just threaten your money. It threatens your identity. It forces you to admit you don't fully control outcomes. And for most people, that feels more uncomfortable than staying poor in a predictable way. There was a man in his late 30s who had a stable job. Every month, he saved a little money. He knew investing could grow it, but he never started. Not because he didn't understand it, but because every time he imagined losing even a small amount, his mind replayed it like a disaster movie. What if I lose it all? Became louder than what if I grow it over time? So he stayed safe. Years passed. Inflation quietly reduced his savings power. Meanwhile, others who started with the same fear learned something crucial. Risk is not a single moment of loss. It's a long game of probabilities. Here's the hidden truth. Avoiding risk doesn't remove it. It just guarantees a different kind of risk, the risk of not growing at all. And this is where wealth quietly separates two types of people. One group avoids discomfort today and pays for it in their future. The other accepts small uncertainty today to buy larger certainty later. If you're watching this closely, you might realize something important. Most financial decisions are not logical decisions. They're emotional negotiations with fear. That's why people stay in jobs they hate for decades. That's why they delay investing even when they know they should. Not because they lack intelligence, but because fear feels like safety. So ask yourself honestly, are you avoiding risk? Or are you avoiding growth disguised as risk? And if this perspective is shifting something for you, subscribe and stay with this series. We're breaking down the psychology behind wealth most people never see. And comment below, what's one financial risk you've been delaying out of fear? Because the moment you understand this, you stop chasing no risk and start building a life where risk is managed, not feared. There's a strange illusion that traps people for years. You start looking rich before you ever become financially secure. It doesn't feel like a mistake in the moment. It feels like progress. The upgraded phone, the better clothes, the nicer car, the aesthetic lifestyle that makes you feel like you've made it. But underneath it all, nothing actually changes in your bank account. Only the image changes. And that's the danger. Because society rewards appearance first. People treat you differently when you look successful. You get more respect, more attention, more validation. And slowly, Your brain starts confusing that external validation with real financial progress. There was a man who worked in sales. He wasn't earning much in the beginning, but he realized something early. People trusted him more when he dressed expensively. So he started upgrading his appearance. Better watch, better shoes, better phone. And yes, his income increased slightly. But something else also changed. His expenses increased faster than his income. He started maintaining an image that required constant funding. Every time his financial situation improved a little, his lifestyle adjusted upward immediately. Not because he was wealthy, but because he wanted to appear wealthy. And that's the trap. Looking rich forces you into expenses that prevent you from becoming rich. Real wealth behaves differently. It is quiet. It is often invisible. It grows behind the scenes while others are busy displaying symbols of success. The uncomfortable truth is this. Most people don't realize they're trading financial freedom for social approval. Every upgrade becomes a new baseline they have to maintain. And over time, the cost of maintaining the image becomes heavier than building actual assets. If you feel this hits close, pause for a moment and reflect. Are your biggest financial decisions improving your net worth or your appearance? And if this is making sense, subscribe and stay with this series because we go deeper into how money psychology really works beyond what most people are taught. And comment below, what's one thing people buy just to look successful, not be successful? Because real wealth isn't what people see when they look at you. It's what remains when nobody is watching. Most people don't fail at money because they earn too little. They fail because they think too short. We live in a world that trains your brain for instant results. Instant messages, instant entertainment, instant purchases. So naturally, when it comes to money, people expect the same speed, quick returns, fast success, overnight change. But wealth doesn't grow in the same environment that impatience thrives in. Imagine planting a tree and digging it up every week to check if it's growing. That's exactly what most people do with their finances. They invest for a few months, get disappointed, stop. They save for a short period, face an emergency, withdraw everything. They start something long-term, then quit when it doesn't feel rewarding immediately. There was a man who started investing a small amount every month in his 20s. Nothing impressive, just consistent. His friends used to laugh at him because the returns looked too small to matter. So he almost stopped. But he didn't. He kept going. Not because he was confident, but because he refused to let short-term thinking decide his future. Years passed. Life moved on. His friends earned more at different points, but kept restarting their financial journey over and over. He didn't. He simply stayed in the game. And that's when compounding reveals its truth, not as a mathematical formula, but as a reward for patience. Here's what most people miss. Long-term thinking doesn't mean waiting. It means continuing when there's no immediate reward. If you're still watching this, ask yourself honestly, how many financial decisions have you abandoned just because the results weren't fast enough? If this is making sense, subscribe and stay with this series because we're breaking down the mental patterns that quietly shape your financial future. And comment below, what's one thing you started but stopped too early? Because in money, the biggest difference between people is not intelligence. It's how long they can think without needing immediate proof. Most people think saving and investing are the same thing. They're not. And misunderstanding this difference quietly keeps millions of people stuck in the same financial position for years. Saving is about protection. Investing is about growth. But here's where it gets tricky. Most people treat saving like it will make them rich and treat investing like it's too dangerous to even try. So they end up in the middle. Safe, but stuck. Think about it. You save money in a bank account, expecting it to feel secure. And yes, it protects you from emergencies. But over time, something invisible happens. Your money stops growing in real terms. Inflation slowly eats its value while you feel like you're doing the right thing. There was a man who saved for years with discipline. Everyone praised him for being responsible. He avoided risk, avoided loss, avoided mistakes. But when he finally needed that money years later, he realized something painful. The money was still there, but it didn't have the same power it once did. What could buy had changed. On the other side, investing feels uncomfortable at first. Because it introduces uncertainty. Numbers go up and down. It forces you to think long-term instead of feeling safe in the present. So most people avoid it or delay it until someday. But here's the truth. Saving alone preserves your money. Investing grows it. And wealth is not built by preservation. It's built by growth over time. If you're still watching, here's a question worth sitting with. Are you only protecting your money, or are you also making it work for your future? And if this is starting to shift how you see money, subscribe and stay with this series, because we're breaking down the real financial psychology most people never learn in school. And comment below, do you think you lean more towards saving or investing right now? Because real financial progress begins the moment your money stops sitting still and starts working while you're living your life. What if the real secret to wealth is not how much you earn, but how long you stay patient when nothing looks impressive? Because compounding doesn't feel powerful in the beginning. In fact, it feels disappointing. Small numbers, slow progress, almost like nothing is happening. And that's exactly why most people quit too early. There was a man who started investing a very small amount every month. At first, the returns were so low he barely noticed any change. He checked his account often, expecting something exciting, but nothing dramatic happened. So for a moment, he questioned it. Is this even worth it? That's the dangerous stage, when compounding is working, but silently. It doesn't reward attention. It rewards consistency. So he made a decision, not to increase the amount, not to chase something bigger, just to stay consistent. Month after month, year after year, he kept going even when it felt pointless. And something interesting happened. Nothing changed for a long time, until suddenly everything started changing faster than he expected. The growth that once felt invisible began accelerating. The money didn't grow linearly anymore. It started growing on top of itself. That's the hidden force of compounding. It doesn't build wealth step by step. It builds it layer by layer, and then all at once. Here's the part most people never understand. Compounding rewards time more than talent. It doesn't care how smart you are in the beginning. It only cares how long you refuse to stop. If you're watching this closely, ask yourself, how many things in your life did you stop doing right before they could have started working for you? If this is clicking for you, subscribe and stay with this series, because we're breaking down the psychology behind money that most people never talk about. And comment below, what's one habit you stopped too early that might have changed your life? And here's your rehook. What looks small today is often what becomes unstoppable tomorrow if you don't interrupt it. You can have intelligence, opportunity, even income, and still fail to build wealth for one simple reason. You don't have the discipline to stay consistent when nothing feels rewarding. Because wealth is not created in moments of excitement. It's created in moments of repetition when nobody is clapping, nobody is watching, and your progress feels almost invisible. There was a man who understood money well enough to know what to do. He knew he should invest. He knew he should avoid unnecessary spending. He knew the basics. But knowledge wasn't his problem. Consistency was. He would start strong, saving, planning, feeling motivated. Then life would happen. A friend's wedding, a sudden expense, a stressful month, and slowly, his system would break. Not all at once, but in small compromises that felt harmless in the moment. I'll start again next month, he would say, and he did, again and again. What he didn't realize was that wealth doesn't punish mistakes as much as it punishes inconsistency. Because every time you stop and restart, you reset momentum. And without momentum, even the best strategy becomes powerless. Now here's the turning point most people miss. Discipline is not about intensity. It's about continuity. It's not about doing something perfectly for a short time. It's about doing it imperfectly for a long time. Think about it like a river carving through rock. It doesn't break the stone with force. It breaks it with patience. If you're still watching, here's a moment to reflect. How many times have you restarted your financial habits instead of protecting the ones you already built? And if this is resonating with you, subscribe and stay with this series because we're breaking down the real psychology behind wealth, not the surface level advice most people repeat. And comment below, what's one habit you struggle to stay consistent with? Here's your rehook. Discipline isn't what you do when you feel motivated. It's what you protect when you don't. And that difference decides everything. Most people spend their entire life working hard without ever realizing they're building the wrong thing. Because the real difference between wealth and struggle is not how much money you make. It's what you choose to own versus what you choose to carry. And this is where one simple concept changes everything. Assets versus liabilities. At first, it sounds obvious. But in real life, people confuse the two every single day. An asset puts money into your pocket. A liability takes money out of it. That's it. Simple. But life makes it complicated. There was a man who thought he was improving his lifestyle every year. A better car, a bigger house, newer gadgets. It felt like progress. It felt like success. But every upgrade came with more payments, more stress, more obligations. His income increased over time, but his freedom didn't. Because what he was collecting were not assets. They were liabilities disguised as rewards. Now compare that with someone who quietly focused on buying things that generated income. Small investments, simple assets, nothing flashy, no attention, no validation. But over time, those small decisions started building something powerful in the background: cash flow. Here's the turning point most people miss. Wealth is not built by what you earn, but by what you keep and grow. If you're still watching, pause for a second and ask yourself, how much of your money is going toward things that grow your life versus things that maintain your lifestyle? And if this is starting to shift your thinking, subscribe and stay with this series because we're breaking down money psychology most people never learn, but everyone feels the consequences of. And comment below, what's one thing you once thought was an asset, but later realized it wasn't? Here's your rehook. The moment you stop chasing things that look rich and start owning things that actually make you rich, your entire financial direction changes. Most people believe they make financial decisions with logic. But in reality, money decisions are emotional decisions wearing a logical mask. Every purchase, every investment, every financial delay, it's not just math. It's emotion trying to protect you from discomfort. Fear, pride, insecurity, excitement. These are the real drivers behind money behavior, not spreadsheets. There was a man who knew all the right financial principles. He understood saving, investing, risk management. On paper, he looked like he had everything under control, but his actions told a different story. When markets were rising, he felt urgency, not to miss out. When markets were falling, he felt fear, not to lose what he had. When friends earned more, he felt pressure, not to be left behind. So his decisions kept changing with his emotions. He would buy high out of excitement and avoid investing low out of fear. Not because he didn't know better, but because emotions were making the final call. And that's the hidden truth. Most people don't lose money because of bad strategies. They lose money because emotions override strategy at the worst possible moments. Think about it. Fear stops people from investing when prices are low. Greed pushes them to buy when prices are high. Pride prevents them from admitting mistakes. And comparison makes them spend money they don't have just to feel equal. If you're still watching, take a moment and reflect how many of your financial decisions were actually reactions to emotion, not rational planning. And if this is starting to make sense, subscribe and stay with this series because we're breaking down the psychology of money that most people live through but never understand. And comment below, what emotion do you think influences your money the most? Fear, pride, or comparison? Here's your rehook. Until you understand what's really controlling your decisions, you're not managing money, your emotions are. If you strip away all the complexity of money, all the strategies, all the advice, you're left with one simple truth. Wealth is not a math problem. It's a psychology problem. Because the way you think, feel, and react around money quietly decide your financial future long before any investment ever grows or fails. Most people believe they need more income to become rich, but many people with high income still struggle financially. Why? Because their emotions are still in control of their decisions. Think about it. Someone earns more, so they upgrade their lifestyle. A better car, a bigger house, more subscriptions, more pressure. And suddenly, every raise doesn't create freedom. It creates new obligations. There was a man who kept increasing his income over the years. From the outside, it looked like progress. But inside his financial life, nothing really changed. He was still waiting for the right time to invest seriously. Still reacting to fear when markets dropped. Still spending to feel rewarded after stress. What changed his situation wasn't more money, it was awareness. The moment he started noticing his emotional triggers, everything shifted. He stopped buying out of stress. He stopped delaying decisions out of fear. He stopped comparing his financial life to others. And slowly, for the first time, he started directing money instead of reacting to it. Because once you understand this, money stops being something that controls you and becomes something you control. If you've watched this far, take a moment and reflect. Are your financial decisions truly yours, or are they shaped by emotions you never questioned? And if this series is helping you see money differently, subscribe and stay with it, because we're breaking down the real psychology behind wealth step by step. And comment below, what's one emotional pattern you now realize has been affecting your money decisions? Here's your final rehook. The moment you change your mind, you don't just change how you think about money. You change what your financial future becomes.